Hello, everyone, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Anne Berry, and we're here today to discuss the Fed's recent decision to pause rate hikes for the second time this year. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep your portfolio on track. Today, we are here with a recurring guest, one of my favorite interviewees, Danielle DiMartino Booth, CEO and Chief Strategist of QI Research, to discuss the Fed's recent interest rate decision. Danielle, welcome to Public. And I'm so excited because I know you're fired up. You've got lots of points of view on what we saw today. So are you ready to dive in?
I'm absolutely ready to dive in. And you know me, I get all hyped up on Fed Day. So pure adrenaline.
I got it. I love it. The adrenaline is flowing. But even though the Fed decided to not take action today, the Fed decided to halt rate hikes following its September FOMC meeting concluded. So what were the key takeaways, Danielle? What was the decision and what was the context the Fed provided for the decision?
So I think probably the initial knee-jerk reaction in markets, one of the reasons that we're seeing stocks in the red right now is that it's not so much the pause that occurred today, but it's more so that over the next 2 years, they took 2 rate cuts out of the picture, meaning higher for longer. They're going to maintain high interest rates for longer than what the market had been pricing in, for longer than what most investors had been expecting. I think some people were kind of anticipating, that, look, the government might shut down. Student loan payments have resumed. The UAW is on strike. There's all kinds of things that are battering away the economy right now. And yet somehow out of this sea of uncertainty, the Fed is more resolute to stay higher for longer than it was just a few weeks ago.
So Danielle, how much longer? So let's break it down into the specifics. When you looked at the dot plot, and you looked at what the market was expecting, when was a rate cut expected to kick in before today? And now what is the expectation for when a rate cut will happen?
So in terms of the when, right now it's about a 50-50 toss-up on November being a subsequent rate hike.
Yep. Okay. That's 23. Yep.
That's 23. And then you get into 2024. And I think markets had been anticipating almost 4 rate cuts for 2024. And that really did come down to about 3 max. And that's the point here, is that in the dot plot, the Fed increased its expectation for economic growth, for GDP, from 1.5% to 2.1%. There is going to be some softness, but generally speaking, their assessment of the economy right now is that it's on stronger footing than it was the last time they released the so-called dot plot. So, they do expect that they're going to get to their 2% inflation target, but boy, it's going to take them some time. And Jay Powell has said, we're no near declaring mission accomplished.
So when we just come back on this timing and just to sort of really put a pin in this, Danielle, the market, if you looked at consensus until recently, felt that perhaps as early as March, at the end of Q1 of next year of 2024, we might see a rate cut. Coming out of today specifically, are you saying that the rate cut is unlikely to happen until the summer of 2024, or is it going to be even later than that?
So, I think as far as timing goes, one of the more frustrating aspects of today's press conference with Chair Powell is that he refused to be pinned down, to use your word. He refused. He used the word carefully over and over and over again. He kept saying that if the facts change, we will change our path. But the important thing is not so much the timing, but the magnitude of rate cuts, which has come down appreciably. So they're saying this is not going to be like the rate cut cycles that we have become accustomed to. It's not going to be great big gaps down 3/4 of a percentage point, 1 entire percentage point. And that is the definition of a soft landing. That means that they don't have to be reactionary and be dramatic. But by the same token, this is nothing. We haven't seen anything like this in 40 years. So it's as if somebody's taken investors' playbook away and burned it.
Right. Let's talk a little bit about one of the core parts of that playbook, Danielle, which is inflationary expectations, and look at what the data has been showing. The Fed and those of us who are observing the market, we saw the inflation data from the August CPI increased by 0.6% from July, 3.7% growth on an annual basis. much of that inflation jump was attributable to rising energy prices, which when you take a big step back and take a look at the global oil price dynamic, doesn't necessarily show signs of slowing down anytime soon. So what insight did the Fed provide today regarding the expectation on where inflation goes between now and the end of the year?
So they do see inflation coming down they see inflation in 2024 dipping below 3%, and they're referring to the core PCE. But he also, to your point, said that among the shocks to the system or potential shocks to the system that they're taking into consideration in their deliberations is an oil price shock, to use his words. So even though the Fed, even though specifically Powell's always trying to focus our sights on netting out this and that, he did speak to high gas prices today, high gasoline prices at the podium. That's something that he is factoring in, even though it's completely out of his control, which he has always maintained. But again, if it means higher for longer, then that gives him more of an opportunity to continue chipping away at investors, presuming that the Fed's always going to step in and save their investments. And he is trying to break this mindset, and he's finding it very difficult to do so. But boy, he's resolute.
Let's talk about labor as well and what we've been seeing in the labor market, Danielle. Another crucial factor for the Fed to consider. The unemployment rate currently at 3.8%. We've seen slightly softening labor market data towards the tail end of the summer. But that 3.8 unemployment rate is still pretty, a sign of a robust labor market, is it not? What did the Fed have to say about that?
They had to say that they were taking their unemployment rate forecast for the current year from 4.5% to 4.1%. So they're saying that there's going to be more job creation than what they anticipated in June, that the landing's going to be even softer than it was back when they last put the dot plot together. That's a big chunk, by the way, for economists, taking the unemployment rate forecast down from 4.5% to 4.1%. The unemployment rate moved that much in 1 month. And yet where they think that the year is going to end out.
Yeah, I mean, that's a 10% shift to your point, right, in the actual percentage rate. That is meaningful for many market metrics. You touched at the beginning.
They took their GDP forecast by the same token, meaningfully, from 1.5% to 2.1% for the current year.
Yeah, a third increase. I mean, again, a very meaningful swing. You did nonetheless, Danielle, in some of your earlier comments, point to some of the potential risks that the US economy is facing right now. You alluded to a government shutdown. Let's talk about that some more. You alluded to an auto worker strike. We've talked about energy prices. Let's unpack that. Let's talk about the auto labor workers strike right now. What are your thoughts on what that could mean for the labor market looking stronger for longer?
So I think what you have to figure in when you're talking about the UAW strike is the ripple effect. It's the fact that auto suppliers are going to be affected if, as the head of the UAW has promised, if there's no resolution by Friday, 2 days from now, he said he's going to take the next step. And the suppliers for the big three automakers, remember, this is an unprecedented strike, synchronous across all three major U.S. automakers. We've never seen anything like this. But auto suppliers have said if they push forward on Friday with this, it's going to shave a lot off of our revenue. We're going to start having to lay off people. And that's a ripple effect that is not directly attributable to what the UAW is doing to the three big automakers. And that's relevant because of where we are in this economic cycle.
Let's talk too about the possibility of a government shutdown, Danielle. Talk about something that does move the labor market. The government is still, I think, the biggest employer in the United States. It's been interesting that the commentary around government shutdowns has historically or recently been people are going to wait to see who blinks first, right? There's a lot of chatter about it. There's a lot of panic about it. And then ultimately it doesn't happen. This time, it feels like the commentary is a little bit different, where that there is a real possibility it could happen. And perhaps the impact may not be as profound as folks think. That's been one narrative out there. What do you think of that perspective?
Well, that's an interesting and convenient take. But again, I think if you're speaking about a government shutdown not having a detrimental effect, you really are looking at it in a vacuum, because there's so much happening right now. There really is. And nothing happened, nothing came of the debt ceiling showdown. But by the same token, that introduced a level of humiliation for the far right in the GOP, because they didn't accomplish anything. And that's why you're seeing this far right faction be that much more resolute this time, really pressing House Speaker McCarthy's, putting his feet to the fire, saying, you're going to have to put the border wall up. Things that they know will never fly with Democrats, non-negotiable subject matter. That's what they're talking about right now. And I think this is a reflection of what they feel like they lost during the debt ceiling negotiations, because McCarthy was able to gather some Democrats and literally shut the faction down. So I think that we're closer to the election than we were when we had the debt ceiling shutdown. And I think that the risk is much higher that we actually see this going forward. Of course, look, even if the government shuts down, all of the pay is retroactive. Everything reopens. Everybody gets their back pay. There's not permanent damage to the economy. But again, Americans right now are losing jobs. We've got unemployment insurance going up in 47 different states. That's a lot. And on top of that, you've got people who make decent amounts of money, more than $100,000. The spenders in the economy, they're the ones who are not going to get student loan forgiveness. And they're the ones who have mortgages for the first time. They moved out of city centers. They have car loans for the first time. They're the ones paying back their student loans. And households right now are having to choose. A lot of them are saying, we're not going to go out to eat anymore. And we're seeing that in restaurant sales, actually. They're saying, if I have to spend this much money at the gas pump, I'm going to have to give something else up. And that's corporations losing pricing power. So there are a lot of things going on right now. I think it's impossible to say we're just going to skip past all of these things together.
Well, let's talk about this, Danielle, because there's so many different moving pieces in there, which is always the sort of richness of these conversations. You've got corporations losing pricing power, which should help getting inflation under control. On the one hand, you've just identified a couple of areas of spending that are perhaps being cut back on the discretionary side of household budgets. You just talked about eating out, for example, dining in restaurants. But on the other side, we've seen this interesting trend. Now, this is where it gets anecdotal as opposed to dining trends. Areas, for example, in the tech sector that were doing some of the biggest headcount reductions are ramping back up hiring again in anticipation of a strong consumer pattern. Amazon being a specific point that's going out there and hiring very strongly because they anticipate there's going to be a strong holiday sales season. So the data out there is complicated, it's confusing. So let's get this back to the Fed. If you are the Fed right now and you're looking at the possibility of a government shutdown, you're looking at growth projections, and you're saying, here's my toolkit, which is monetary policy, and the Fed isn't mandated to think or to react necessarily directly to fiscal issues, where does that leave the Fed in trying to figure out how to muddle through the rest of the year?
Well, Jay Powell used one word over and over again today. He said convincing. He has to see convincing data, not just not just 3 months. He has to be convinced that there's sustainability in the economy, what we used to term as geeky economists, exit velocity, that the economy can stand on its own. Of course, he's talking about lagging data. So again, that's where we get back to the higher for longer. If Jay Powell has to be convinced, and I think that really is complicating given how fast things are moving. You just mentioned that Amazon announced it's going to be hiring 250,000 people ahead of the holiday season. Earlier this week, we had Google announce that it was firing hundreds of recruiters. To your point, serious cross currents. Job demand is decreasing in certain places, increasing in other places.
Yeah.
We're seeing delinquencies go up on credit cards. We're seeing delinquencies go up on auto loans. And from Jamie Dimon on down, the people running the lending companies of America are saying that they're seeing delinquency rates normalizing. That's another word. It's a catchword. I mean, for investors, they have to pay attention to words, right? Normalizing means it's moving up the FICO ladder. It's
Although
not
Jamie
just
Dimons also has said multiple times he's seeing core strength in the US consumer as well. So to your point, even some of the messengers,
he just said,
and observe, seeing a lot of strength.
Consumer strong right now. Don't count on it continuing. And that was how he changed his own narrative in his most recent public comments.
And to that point, on using the crystal ball, Danielle, and you've been consistent on this, the problems with using lagging data to make current decisions that are going to impact the future. I'm going to throw a bit of a curveball at you. When you, as I know you did, you were watching very carefully, as many of us were, the Jackson Hole Convention of Central Bankers last month. And I thought it was very interesting that Christine Lagarde, so this is now the ECB, was talking about explicitly the ECB refining its process to be more forward-looking, to be much more focused on what projections were than on lagging indicators, understanding that it would probably have some wrinkles, understanding there'd be errors, and then being transparent about what those forecasting errors are and why. Do you think the Fed is going to start moving in that direction? It was fascinating how clear the path was that she articulated for her policy-making machine.
Well, echoing Christine Lagarde, a big loud echo was Jay Powell saying today forecasting's really difficult and we shouldn't be expected to be, gods among men and women. There's going to be errors in our ability to forecast. He entered humility into the process of monetary policy making. I actually applaud him for saying that. But by the same token, he also kind of defied the message in the dot plots of a strengthening economy, of more momentum. When he was asked point blank by a Reuters reporter if a soft landing was his base case, he interrupted the reporter and said, no, it's not. So you're seeing factions, you're seeing divisions, you're seeing tension on that Federal Open Market Committee. And that's something we really need to pay attention to going forward, because the width of the dot plot in 2024, the disparity between the doves and the hawks has widened. So he denied that there was disagreement, and yet we are starting to see much more dissent on that committee, on the Federal Reserve Board.
Debate versus disagreement, always a nuance in definitions there, Danielle. Final question for you. Let's talk about the Danielle DiMartino Booth crystal ball. Let's talk about your forecast. What are you expecting is going to happen in the November meeting? What is going to be the interest rate decision then?
So I would think that if there was, and now I'm going to sound like an economist, if there's a quick resolution to the UAW strike and we do not have a government shutdown, I could easily see another rate hike coming in November.
25 basis points or more?
No. It would only be 25 basis points.
Okay.
And he actually said at this point, the level of rates doesn't really matter. And by the same token, we're going to continue to significantly reduce the size of the Fed's balance sheet. So he plans on that form of tightening continuing no matter what, not up for discussion. And that is a form of tightening.
Important distinction. One, next time you come on, Danielle, let's talk about that some more, which is actually the use of the balance sheet versus just the headline rate. It's an important technical point that does have real implications, perhaps doesn't get the amount of coverage.
It doesn't, but it's certainly manifesting in the fastest bankruptcy cycle since 2010. So companies are telling us that depleting liquidity from the system matters.
Leaving us on a cliffhanger, Danielle DiMartino Booth, CEO and Chief Strategist, QI Research. As always, fantastic to have you join. Good luck with the rest of Fed Day and come back soon. That's it, folks. Join us again here on Leading Indicators for more conversations with the world's best macro minds.